Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital.
I'm Chad Sheeler, the founder and president of Focus Capital.
Chad, most investors understand that real estate comes with tax advantages, but one of the most powerful and least talked about tools, in my opinion, is the cost segregation study, or a cost seg. So today we're going to break down on what that is, how it works, and who should be thinking about it. So from a general landscape, what is a cost segregation study?
Yeah, a cost seg study is what we do on every property when we acquire it. Essentially, is a way to accelerate the depreciation for investors in the first year of ownership. So what that means is, normally a properties are depreciated on a certain schedule, whether it be 5-year, 15-year, 27.5-year property lifespans. We can accelerate all of that into the first year to where it's a lot more depreciation. A cost seg study is needed to have it done by a professional third-party company who can really certify those studies to use that in our tax preparation.
Yeah, and I think it's important for everyone who's listening and watching to know that it is an IRS compliant engineering analysis, and you can get depreciation over the lifetime of an asset without doing it. But this is just an acceleration vehicle, so it's not like it doesn't change what you owe over the life of the investment, but it changes when you owe it.
Yeah, it's really the missing link it's the key that you need to do to get that depreciation accelerated in the first year. You have to have it done by a cost seg study company.
Yeah, and the segregation part of that is, which certain components you can depreciate and which you can't, and segregating those out so that way you can have it more upfront tax advantages. Again, not changing how much you owe, just when you're owing those things.
Correct.
Speaking of accelerated depreciation, so how does accelerated depreciation benefit investors?
Well, if you have other taxable income or other passive income, passive gains that you can offset with a greater amount of passive losses through depreciation, well, you're going to pay less taxes on that money. So it's a big tax benefit in the first year to have those losses. Now, if you can't use it, obviously, we discussed in past episodes about tax benefits, it would just carry forward to future years.
Yeah, I think that another thing that is the time value of money there is because, well, in the previous question, we talked about it doesn't change how much you're quote unquote saving, but $1 saved today is going to be worth more than $1 saved in 10 years, 27 years, 35 years, whatever the lifetime of that asset is, because they can either reinvest that or put it in a different vehicle, but then also the value of that dollar is going to go down in 10 years. Even if we don't know who's going to be in office, we don't know what any rates are, we know that just with inflation alone, saving that dollar up front is worth more than saving that exact dollar amount later on.
Yeah, I definitely agree with that. For a quick scenario, let's say you put in $200,000 as an investment, hypothetically, and a cost seg study, because of the depreciation you got in the first year, would benefit them an additional $100,000 in a tax deduction through depreciation. If you're at a 40% tax bracket, it's $40,000 that you would have paid on tax in that first year. Mm-hmm. Now, if you can wipe all that out, putting that $40,000 to work in an investment right now is much more advantageous than having to wait future years, take after-tax dollars in that first year and this way you put the other money to work to earn money over those next few years.
Yeah. We talked a little bit about the accelerated depreciation, but I also wanted to talk about bonus depreciation and how it interacts with a cost seg. I think that bonus depreciation has been a big topic on a lot of podcasts, but how does that layer into or on top of a cost seg study?
Well, bonus depreciation essentially means that right now it's 100%. Mm-hmm. So you can get 100% bonus depreciation on the 5 and 15-year property, which that's all more of a tax question and CPA question. But it is a part of the accelerated depreciation, the bonus calculation is.
Yeah, and I would say that this is where the conversation with the qualified tax professional becomes more essential, because there's these little nuances and changes that sometimes happen year to year. Right now it's 100%, but then depending on certain legislature that comes out and certain changes, and sometimes even at your state level, there are certain extra bonuses that you can claim at certain times with certain properties. And so just wanted to throw that out there that neither one of us are tax professionals here.
Right. Plan to be.
And we don't plan on being. I think that one of the biggest things when you're working with any operator, we've talked about how important it is to work with an operator that knows their stuff. Is it's just important to know what you don't know and what you're not good at. And for us, we leave the tax stuff for the professionals.
Yep.
We do need to understand certain components of this and how it benefits our investors. But when it comes down to the nitty gritty, definitely talk to your CPA. We talked about how this benefits investors, but who specifically benefits from the strategy? And I think that this is one I want to spend time on because I'm in investor relations. Not every investor should run out and order a cost seg study, especially like if they're not an LP in a fund, if they're just doing their own active investing. So I would say, who is this designed for, and who does it bring the most value to? My first thought, given our space, is anyone who owns or invests in a commercial or multifamily property because it's a large asset. Because that meaningful tax income will help them offset anything in the first year. Could you think of a couple of other scenarios of where this would be the most valuable for?
Well, it really is most valuable for the investor or group of investors that can use that extra depreciation the first year. Mm-hmm. If you really can't use it at all and you're a single investor in one property, then does it make sense to go pay $5,000+ for a cost seg study if you can't even use depreciation the first year? Mm-hmm. Probably not. Another point there is it also matters in the size of the property. If you're going to buy a property that's $500,000, well, paying $5,000 for a cost seg study, which is probably going rate $5,000 to $7,000, it may not be worth it to pay for that study. Now, a lot of times, smaller properties, in my experience, again, not a tax professional, but my experience, those smaller assets, let's call it $1 million less or below, your CPA may be able to perform that study for you because you're at much lower risk for an audit, for example. So you have to outweigh the cost of the study compared to what you're going to gain from that, if you even would gain from depreciation.
Yeah, I would say that on top of passive investors, real estate professionals that have passive income to shelter would also benefit from a cost seg.
Yeah, if you've got the passive income there.
Yeah, and then and just adding on to what you said, like someone that's in a strong enough tax bracket where large deductions actually create real savings. Like there are some people where it's like, yeah, you would have all, like the example you gave, $200K, 80% of that. Well, what if they don't even have that big of a tax liability anyway? So it's the benefit is there, but you're not going to get more money back. It would just be a decreasing your liability. And if you're not in a tax bracket that you have that level of liability, it's not going to give you the most value.
Yeah, exactly. And it's in occasions where you have a lot of investors, usually a sponsor or operator will go and perform the cost seg study for the entire property, the entire investor group, knowing that maybe not everyone can use a depreciation against their other passive income or passive gains, but it's there for everyone to use if they can use it.
The nice thing is we have a few investors that are invested with us and other real estate private equity firms, and they can, if working with a tax professional, the cost seg depreciation that we give them through a K1 can also be used to offset passive income from other real estate investments as well. So it's kind of a tangential loop there. Other than the cost of the actual study, is there any situations that we haven't mentioned yet where a cost seg study doesn't make sense? I like the one that you had said, where if a property is $500K and you're gonna be paying, $5,000 for it, you're kind of at a net zero anyway. Can you think of any other situations where it wouldn't make sense to perform one of those?
I think one would be if the cost is prohibitive to the results, and if you can't use depreciation anyway, and you're the only investor on a deal, probably wouldn't make sense anyways to use that.
Yeah, I also think that if someone is in like the fast flip business, like any investors who plan to sell quickly and need to understand a little bit about depreciation recapture, because the IRS will recapture those accelerated deductions at the sale, which should be considered in your exit strategy. All of our holds here are 5+ years, 5 to 7 year holds. If someone is only looking to hold an asset for, 1 to maximum of 3 years, that depreciation recapture is really going to kick in.
Yeah, it's a higher rate.
Yeah, exactly. And so those are things that people should consider, lifetime of the asset, and then what your actual exit strategy is. If this is something I'm going to hold for less than a year or 18 months, like a cost seg study probably is not going to provide the most value for you.
Yeah. Yeah, that's a great point.
How should passive investors think about this? So for someone investing through a syndication, they're not running the study themselves, like you said. Yeah. Usually the sponsor will run it for them if they're a good sponsor and operator. What should they understand about how this flows through to them at a high level?
Yeah, I think high level, it's okay, the property, the entity that owns the asset and that all the investors have invested into that are members of that entity, they all get a prorated share of their equity, right? all the depreciation that the property receives from the cost seg study flows to the entity level, the property level, and then it's split pro rata among the GPs and LPs, and in the LP bucket, it's going to be okay. So that's split among your pro rata ownership of that LP entity.
And then that comes in the form of a K1.
Correct.
Perfect. And so I think the biggest thing on that side is the reason why experienced investors often say that real estate's true return isn't just the cash flow, it's the after-tax cash flow. They kind of understand that game of it's not just the cash on cash distribution. It's not just the windfall of the exit strategy. It's also, this is one of the most unique investment vehicles, unlike, being in public markets or anything like that, that provides these types of benefits.
Yeah, exactly. I mean, when you look at it that way with after-tax returns, if you don't get the depreciation year one at all, and the depreciation is just rolled over, carried forward to future years, really your cash flows for the most part are probably not taxed at all for the next 4 or 5 years. So really, if let's say you're earning a 6% cash on cash return, that's probably more like 8% after tax, right?
Yeah. I would say though, one caveat is to reframe kind of this whole conversation. People are probably thinking of like, oh, this is a tax loophole. A cost seg is not a loophole. It's a structured like IRS sanctioned tool that rewards investors who understand the tax code and plan accordingly, or tax professionals that work with their investors. I think that investors who benefit the most aren't necessarily the ones in like the quote unquote best deals. They're often the ones who are the most deliberate about how their investments are structured. So when evaluating an operator, ask them, what is your depreciation plan? Do you guys plan on doing a cost seg study? Like you said, if it's a smaller asset, might not be worth it from the upfront funds. But for bigger assets and larger properties, like it's definitely worth that cost. Anything for closing?
No, that was great. You covered like 7 points there.
Yes. I think the biggest thing for me outside of that, reframing and not talking about how this is a loophole, it's like it's a tool. And if every tool needs to be used properly is, again, consult your CPA or tax advisor before making any decisions here. But understanding the tool is the first step to having the right conversation with the right professionals.
Exactly. And the IRS code is literally written to tell you how to not pay taxes. And it's really, the code is there to favor businesses in real estate. The U.S. wants the growth of those things. So that's what it's there for you.
Once you understand the rules of any game, you can play the game to like the fullest potential. And so this is just it's a real estate. Everyone talks about this, the real estate game, the investing game, the tax game. It is a game, but in order to be the best player, you first have to understand the rules, or at least have a coach or professional that understands the rules and can help guide you through that.
Yep, exactly.
All right. Thanks so much for your time.
Yeah, you bet.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.